Enbridge is one of the best stocks that you can invest in for a rich and rewarding retirement. This is because it has a very attractive current income yield, it has a very strong and impressive dividend growth track record, it has a very safe and durable business model, and has a very strong balance sheet. Hi everyone, this is Samuel Smith. I run High Yield Investor, the top-ranked investing group on Seeking Alpha, and I specialize in dividend investing. Before I get into discussing Enbridge and why it is such a great stock to invest in for a rich and rewarding retirement, I'd like to ask if you could please like this video and subscribe to my channel, because I just started on YouTube to share my unique approach to dividend investing with a larger audience, and I need your help to make it a success. Thank you very much. The first reason why Enbridge is such a great stock to retire on is because it has a very safe and durable business model. This stems from the fact that it is becoming increasingly a hybrid between midstream infrastructure as well as regulated utility assets, both of which have very stable cash flows. The midstream infrastructure business has a combination of both contracted long-term pipeline and other midstream assets, and even some renewable power generation assets that have long-term power purchase agreements attached to them, as well as regulated assets that have significant cash flow visibility because they're akin to utilities that have regulated guaranteed rates of return as well. Nearly 100% of their cash flows come from either contracted or regulated assets, so the amount that is subject to commodity volatility is in the low single-digit percentages. As a result, their cash flows are very stable through all sorts of energy and macroeconomic environments, making it a very stable cash flow generator. Moreover, because its assets are so well diversified and are so mission critical to the energy supply chain, including their expansion into renewable power generation, which sets them up with a nice growth vertical for the future, even if renewable power does become more prominent relative to hydrocarbons and funding the energy supply chain, they should be able to generate significant cash flows for decades to come without having to worry about technological disruption or severe recessions. Because again, these contracts are to about 95% investment grade counterparties. So even if the energy industry is struggling or the utility sector is struggling, they should still be getting their contracts honored, and they're going to be getting their cash flows regardless. Additionally, the regulated assets are also going to be getting their cash flows regardless. And so Enbridge enjoys a very long and stable cash flow profile. The second reason why I really like Enbridge as a stock to retire on for dividends is because it has a very strong balance sheet. It has a BBB plus credit rating from S&P, which puts it on par with some of the most financially robust firms in the midstream sector. Only Enterprise Products Partners has a higher credit rating in the midstream space at A-. And I will leave a link in the comments below to that video where I discuss Enterprise Products Partners, and you might want to check it out. But Enbridge also has a very strong balance sheet. While its leverage ratio is a bit higher than Enterprise Products Partners, this is fine because it has more regulated exposure, and because regulated assets are considered to be safer and more durable than even contracted assets, you can support higher leverage with regulated assets because you don't have to worry about your cash flow volatility spiking, and therefore you can service your debt much more easily. Additionally, Enbridge has very, very long terms to maturity on its debt, with some of its debt even not maturing until 2080. And so it can enjoy very stable cash flows and also have a very predictable interest rate expense for many years to come because it has mostly fixed interest rates and very long terms to maturity on average. The third reason why I really like Enbridge as a passive income generation machine is because it has a very impressive dividend growth track record. It has grown its dividend every year for about 29 years in a row at a roughly mid-single digit pace over that period. This means that year after year after year, not only is it generating sufficiently stable cash flows to support its current dividend, which is quite high, but it's actually able to increase it. Not only increase it, but increase it at a rate that exceeds inflation. This means that the business model is generating significant additional value for shareholders because not only is the business just treading water on a dollar-adjusted basis, but it's actually growing it. And it's not only growing it, but it's growing it despite not retaining that much cash flow. This shows that there's organic asset growth, as well as the little bit of cash that management is retaining. It is investing intelligently into projects that are actually growing the cash flows. And this is also important because dividend growth over the long term, especially if it exceeds inflation, which it expects to do at a roughly 3 to 5% CAGR over the long term, so it shouldn't exceed inflation over time. This is important because it will not only protect, but it'll actually increase the buying power of your passive income that you get from Enbridge because it's going to be growing each year faster than your average costs will be increasing. The fourth and perhaps most important reason why I like Enbridge so much as a passive income vehicle is because its current dividend yield is so attractive, sitting well in excess of 7% while also being covered substantially by distributable cash flow. This means that even if there is a blip in cash flow for Enbridge, which is unlikely given the aforementioned strength of its business model, Enbridge should be able to easily support its current dividend and also pay out a very attractive dividend, so you do not have to save nearly as much money to still generate the same amount of passive income from your investments, thereby enabling you to potentially retire earlier. So for example, if you have a $1 million portfolio and you're investing in Enbridge, while I do not necessarily recommend investing in a single stock for retirement, in a hypothetical scenario, you would be generating over $70,000 in passive income from Enbridge. In contrast, say if you had that money invested in the S&P 500, which has roughly a 1.4% dividend yield, you'd only be generating $14,000 a year in passive income. Or say you invested in the ticker symbol SCHD ETF, which is a very popular dividend growth ETF. That one only has about a 3.4% dividend yield, so you'd only be getting about $34,000, maybe $35,000 a year in passive income. So with Enbridge, you're going to be getting more than double what even SCHD would offer you. And so that just shows you how powerful of a passive income machine it is. So even if it's just one constituent in your portfolio of, say, 25 or even 50 stocks, it still is going to help increase your average yield, thereby enabling you to retire sooner while still generating dividend growth that should exceed inflation for years to come. If you enjoyed this video and learning how Enbridge can help accelerate your passive income accumulation journey, please like it and subscribe to my channel. I plan to release many more videos in the coming days and weeks that will outline more of my top income investment picks, as well as sharing my unique dividend investing strategy that has helped me to beat the market significantly since I launched my portfolio years ago. Thank you very much. See you next time.